I tell my clients, I'm not trying to get you rich. I'm trying to keep you rich. And so if I can increase your income and keep you rich, it's a win-win, right? So, but I just tell them straight up. And maybe it's not, for some, it doesn't work. For some, it's fantastic.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Mr. Ben Carmona, thank you so much for being here. Super appreciate it. You got some super cool topics. As we were just catching up before we started recording today, we're talking about 1031 exchanges, Delaware Statutory Trusts, some other really cool stuff. And what I love about the topics you're going to be covering for us today and for the listeners is that this isn't just the stuff you hear every day, right? These are things that if you're a more informed investor, this is going to help take you to that next level. I know many of you that are listening on the podcast maybe just be hearing about, syndications and funds and getting your feet into alternate investments. So we have an expert today on these topics I just mentioned. Ben, thanks so much for being here. Just please quickly introduce yourself, who you are, where you're from, and let's dive into these topics.
Absolutely. Thank you, Stephen. It's a pleasure to be here. Talk to your audience. I appreciate the opportunity. I am financial advisor, so I didn't know if you wanted me to go personal or professional. I'll just keep it professional until you say otherwise.
Sure.
I am a financial advisor by title, if you will. So I'm securities licensed. But I'm not your standard financial advisor that's doing stocks and bonds, mutual funds and annuities, insurance. Like I've lived my whole career in the, as you said it, alternative investment arena.
Mm-hmm.
And really, folks ask what are alternative investments, and I would say really investments outside of your traditional stocks, bonds, mutual funds, and insurance. Like what else is there out there? And a lot of it's in real estate and private real estate and debt. 1031 exchanges, which we're going to touch on. There's a multitude of other investments out there that I've specialized my entire career, almost 20 years.
Awesome.
And yeah, I'll say this, and I'll stop, Stephen. And, so I serve accredited or high net worth clients, typically baby boomers, seniors that are in their 60s, 70s, 80s, 90s, and they're looking to diversify their portfolios or divest from active management in real estate. And they're looking at, maximizing passive income, mitigating risk, mitigating tax mitigation, so on and so forth.
Yeah, cool. The listeners are definitely familiar with, understanding what an accredited investor is. Many of the tech professionals, again, working for the Amazons and Netflix, Googles, and so forth. So, right in that accredited investor, sweet spot, so to speak. And so, where you might be talking about working with people that might be baby boomers, et cetera. You might have a listener, a pretty standard listener who's right around, 30 years old listening in, who is probably doing 250, 350, 400, just to give you an environment. So they're looking at some of the goals being, what is it like to replace income, right? Because as I'm sure and the listener knows this point, making sure that we can get income, like people think about real estate, to not only, supplement, but hopefully the target is replacing what their income is so that they can reach that quote unquote financial freedom, right? And things like that.
100%.
So,
yep.
It comes to accredited investors, understanding really the basics around passive income. There are many of my episodes for that, but I really want you to help cover and shed some light on these other topics, again, like 1031 exchanges and DSTs, because these would be new. So, let's kind of start from the top and ease our way into this. Tell me a little bit about what actually, I'll let you pick. Where is a better place to start for someone who is becoming a more advanced investor? Should they be thinking about learning about 1031s first, or even just get an idea about a Delaware Statutory Trust? Maybe they have invested, in a syndication, and maybe they're, looking to do another one. Let's kind of target that audience, right? In
Right.
their journey.
Right.
So what should they be thinking about if they have made one syndication investment and looking to learn more?
Sure. Well, I'll just start by saying, for the younger audience, even those that are doing, well, I mean, you're making good money. I mean, which is great, and you want to always diversify the portfolio, right?
Hmm.
Whether it be again, I'm in alternatives, we're all alternatives, but you got to diversify your portfolio. So if you're with Amazon with Steven, you keep your some stock in Amazon. You spread it out, you set up your retirement accounts, you get real estate, you get alts, you get bonds, you name it. Um, from a real estate standpoint, I guess if it's okay, Stephen, I'll start with 1031 exchanges.
Go for it.
1031 exchange is it's an IRS code 1031, Internal Revenue Code 1031, and I would argue that it is the most powerful wealth generating code in the tax code. It's been around for over 100 years, and essentially it allows investment property owners to defer paying taxes on the gains when they sell, as long as they use the proceeds to buy equal to, if not more, real estate relative to the property that they sold. So the IRS is blessing us with the opportunity to invest in real estate, um, and hopefully it appreciates over time, which it always has. And then when it's time to sell, instead of paying, like, I'm in California, you're in Texas, you have a little break, but like 13.3% tax rates, and the 20% Fed, and the net investment tax, depreciation. Instead of paying all these taxes, you can keep that lump sum of money intact and exchange to buy other investment property, right? And it doesn't matter whether you sold a parcel of land that was held for investment purposes, or you sold a multifamily or a hotel. The way the code reads is it's like kind for like kind. So as long as you're selling investment property and you can buy other investment property, you can defer those taxes. There are guidelines there are guidelines that the IRS sets in place, right? So they give us this opportunity to defer, but they don't make it necessarily easy. And I don't know if you want to touch on those or not, but I'll stop there first. Actually, let me just say this. So you think about this 1031, you're able to defer paying taxes. And so Stephen here today, he sells a property that he bought for $500,000, 5 years ago, and now it's worth $1 million. So he does a 1031 exchange. He buys another property for $1 million or $1.5 million, and he continues to exchange throughout his lifetime. And when Steven's 50, maybe he's got a 50 million or whatever, 10 million, 20, $30 million empire of real estate that all started from this 500,000. And he's been able to avoid taxes the whole way,
Mm-hmm.
right? And then Steven passes away at a very old age. And at that point, all of Steven's kids or beneficiaries inherit his real estate empire at that point at a stepped up cost basis, right? So you started at 500,000, it's 50 million or 20 million, whatever it may be. You pass away, all the taxes that you've deferred all these years they go away, and your kids or your beneficiaries inherit the 20 or the $50 million in real estate. And that is the power of the 1031 exchange, right? You call it, you swap until you drop. You swap, exchange, and then you die, unfortunately. But then your kids get reap the benefits of your hard work and prudent investing.
And the kids don't have to pay any of those taxes?
No, sir.
Awesome. And that's what the
Nope. Step up
1031.
in cost, but you get that with stocks and other assets too. But when you pass, your kids get a step up.
Got it. So Does that you were talking about that from something as an example, and thanks so much for providing that example along with the definition as well.
Yeah.
Does that also work for things like syndications? You said like types of investments.
It's a great question. So like lots of syndications out there, and this is where maybe this goes into DSTs, but lots of syndications where you have like a GPLP structure, right? Like so,
Mm-hmm.
Stephen, if you're the general
Yep.
partner, you bought this property, and you're now selling, in interest, LLC interest in XYZ partnership. um, those would not be 1031 exchange eligible per se, right? Because an LLC or excuse me, a limited partnership owner doesn't own the real estate itself. They're not on title. You're on title,
The GP.
and
Mm-hmm.
so in order to be 1031 exchange eligible, you have to be on title. You have to own the real estate versus owning a limited partnership interest into
Mm-hmm.
something. It's like a REIT, right? For those that understand real estate investment trust, when you buy into a REIT, you're buying a share of a company that's investing in real estate. That's not 1031 exchange eligible. So it's got to be It's got to be real property ownership to be eligible.
Got it. So thanks for that example too. So then, if I'm understanding you correctly, and just recapping for the listener too, you were talking about that example of the GPs and the LPs. Um, the GPs being the ownership team raising capital from the limited partners who are investing into actually doing the acquisition and making that deal available to close and take on the next steps. So the GP team, since they're on title, they're the ones that are actually able to take advantage of 1031, or just have the control to make the decision, or is it just kind of both?
Yeah, I mean, it just depends on how the deal is structured. Like you can have, there's so many, you could run your own deal. You'd be the GP, the management team, you put the deal together, and then you have, half of the deal is set up for just cash investors, right? Um, I'm going to invest 100 grand just after tax money into the deal. And you have a lot of investors investing in that 50%. And then you could structure the other 50% of the deal to be, direct owners, right? So you could bring in 1031 money too, and you could just have a series of TICs or tenant in common
Mm-hmm.
owners, which, partial owners of the real estate. And when that deal sells, that in this example, the tenant in common owners that are own the property with you guys could be 1031 eligible, whereas the limited partnership interests that did not buy into the dirt,
Mm-hmm.
but reap the benefits of the investment performance, they would not be eligible, right? Now, the thing with the limited partners is that there's limited risk, right? So you're
Yep.
in there, you hope it's a great deal, you get your income, you get out and it sells, you do well, hopefully. And then if it goes to hell in a handbasket, like, all right, you lost your money, but there's no recourse, right? Whereas
Mm-hmm.
you, the GP, and the other, in this example, the tenant and common owners, they do bear risk.
Yes.
Yeah, so it just depends how you structure it.
Okay, cool. Got it. So, big picture in general, 1031 being that tax code allows to make that investment and continue to defer that taxes through the continuous exchanges over time, as that recap.
Yes, sir.
Cool.
Exactly
So,
right.
moving on from that then, as that concept, talk to me about where DSTs come in, the Delaware Statutory Trust. Just a high level kind of definition for what that is. And I really liked how you gave an example about how that fits in as well.
Sure. Yeah. No, my pleasure. And by all means, if some of the things I say may not make sense, just let me know and I'll try to clarify.
No worries.
So you have the 1031 exchange, right? It's in the code,
Hmm.
and 90% or 95% of 1031 exchanges are done on a direct basis, meaning, Stephen, you sell your property and you want to do a 1031 exchange. And so you, on your own or with the help of a real estate broker or realtor, you're going to find another, hopefully suitable replacement property. right?
Mhm.
And again, there's guidelines, there's time frames that you have to abide by. But typically, you sell your property, you go out on your own, you find another property, you close, you complete your exchange. There are other ways or other vehicles or structures that also are conducive for 1031 exchange purposes. One of which is referred to as a DST, or a Delaware Statutory Trust. And I'll give you a little history. DSTs were created in the 80s. They weren't set up for 1031 exchange purposes at that time, but it's a trust or an entity whereby you have one trustee that manages the trust on behalf of up to 499 beneficial owners. And when you apply this trust to real estate, it creates a fractionalized ownership situation, right? Um, and so in 2004, the IRS came out and blessed this um, trust or ownership structure as constituting as real property ownership, and therefore eligible for 1031 exchanges. So just, full circle. Okay, this fractionalized ownership, you can invest in a deal or crowdfunding or something where you have an interest in this deal and you are going to be rewarded for its return, uh, hopefully. But it's not eligible for 1031 purposes because you just own an interest in the deal. You're not on title in the real estate. With the DST, yes, it allows for fractionalized ownership, but you're actually 1031 eligible, right? So that's the structure itself. And so in my world, there are, and I'm going to throw out big names just so some of your audience maybe can recognize them. But
Mhm.
so like Invesco or Cantor Fitzgerald or Ares or Starwood or Apollo. I mean, we're talking multi-billion-dollar big real estate asset managers. They're in this space, and so, and I refer to them as sponsors. They go out and they'll use their capital, their relationships, their expertise, and they'll buy all sorts of institutional quality real estate. So, for example, a $100 million multifamily 400 unit property in Dallas, Texas,
Mhm.
a $100 million self storage property in Raleigh, North Carolina, a $200 million medical office campus in Orlando. So you got these about 50 or 55 sponsors in my business, for argument's sake, big real estate companies. They go buy this institutional quality real estate, and then they manage it. I mean, soup to nuts, right? So they're paying out monthly distributions. They're sending out quarterly performance reports on the status of that property. They're sending you your end of year tax reports that you can grab and hand to your CPA to do your tax. So these DSTs they're a 1031 exchange, a turnkey 1031 exchange replacement property solution, if you will. Um, and they're not catering to folks like you or I, Stephen, or maybe many of the listeners today. They're really for, again, baby boomers and seniors that have worked their tails off for 20 to 50 years, aggregating, accumulating real estate that they've worked their butts off to manage, and now they're tired. They're tired. They do not want one more phone call from a tenant, right? They don't want to deal with the tenants, the trash, the toilets, the termites, whatever
Oh, yeah.
they say, the three T's. They don't want to deal with it. But they're in a situation where they're thinking, all right, what do I do? If I sell my property, I do not want to get stuck paying this massive tax bill.
Mhm.
And if I sell my property, do an exchange, and do something else direct, I'm still going to have to manage it. And so, like, what am I going to do? And so they're really in a tough spot, and they're hoping and dreaming and praying of a solution that will allow them to relieve themselves of their active management responsibilities and really capture the fruits of all their labor without having to pay tax and on a passive basis. So with that said, going back to these DSTs, if a client sells their $1 million or $500,000 or $5 million property, that they owned for 20 years and they bought for a fraction of what it's worth today. They can sell it and they can exchange into one or multiple of these DSTs, right? So a lady that sells a $2 million property, she doesn't want to manage. I can take that and I can put 300,000 into the multifamily, 300,000 into the life science or self-storage or single tenant triple net portfolio. I can help investors defer taxes via 1031 exchange, mitigate risk via diversification by sector and also by geography, more times than not increase their income, and most importantly to many of our investors is relieve them of their active management responsibilities to give them more time to spend with their families and do what they want to do.
Absolutely.
That's a DST, a long-winded answer of the DST, but those are the benefits for the most part.
No, that's awesome. So I just want to make sure I hit some of the main points on a quick recap then. So the reason why explaining about 1031s first is because that's the strategy for the tax deferral. And so you're saying that the DST is basically this entity where you can have that fractional ownership up to that 499, other fraction slots, right? And you can use a 1031 strategy to roll that money over into a DST. And there are DSTs that have, well, I'll call it invest in different types of assets. You mentioned self-storage, you mentioned, I think, multifamily and something else as well.
Healthcare,
but really,
life science.
Yep, exactly. And so the 1031 rolls into a DST. And so DST becomes this fractionalized ownership entity for these different asset classes. Is that correct?
That's correct.
Okay,
absolutely
solid. And so it is a strategy that works for, like you were talking about, for owners that are on title, not for LPs, but for understanding the strategy for owners that are on title of a property who want to sell and move that money into somewhere else so that you can get the tax deferred benefits, but ultimately not do any active management and also have more time, et cetera, for what they want to do. Right?
That's exactly right.
Okay. Right. Awesome.
Yep.
So how, just curiosity, how does I'm sure there's a lot on this too, but I'm just interested in some of the kind of the high point mechanics of the DST. Like, if it's fractionalized ownership, is there a similar kind of, how do we say, managing interest? Like, there's 499 slots. Does that mean there's really 500 and one of them is like who controls what to invest in?
Right. No, it's a great question. So the sponsor company, right? The group, we'll just use Cantor Fitzgerald, right? The Cantor Fitzgerald, the sponsor that bought the property, they're going to be the trustee of the trust, and that trustee who makes all the decisions. They many times they do carry a position within the DST. I mean, that's something that I look for. Like, I don't want to be recommending a deal where the sponsor is not carrying ownership interest, right? You want alignment of interest.
Yep.
So yeah, that does. That's very, very common. And in all fairness, I forgot. I want to talk about just briefly the downsides of this stuff.
Sure.
Right. Mm-hmm. Because with the DST, if you go into a DST, you're giving up control. Right, you're giving up control to this sponsor company, regardless of how big and well known they are.
Right,
you're stuck in this thing for, call it 5 to 7 years, right? So you're giving up liquidity, and that's one of the things for folks like you and me and your buddies or your listeners, many of them that are younger. You're still shaking and moving, and if you're in the real estate game and you have the time and the expertise to buy deals, more chances than not, you're going to do. I want to say more chances than not. You could do better on your own, and you'd have the flexibility of selling, whenever you want to. And so I just wanted to say that they're illiquid. There's no formal secondary market. You're in there for 5 to 7 years, but there is this large portion of the population, my parents included, this is a dream come true, right? They don't want to be in the real estate game anymore. They want to enjoy their life, and they want a turnkey way of not paying tax.
Yeah.
Yeah,
And
back to you.
I mean, thanks for mentioning that. It's always the trade-off of getting returns and not being active versus going and doing it, right? And, an
Right.
additional caveat on that, just to continue to round out the picture, is you could make more if you knew how to do it and you had the time to do it. Right. That
Yeah.
knows how to do it is an important part of that.
Right. Exactly. Right.
Yeah, key point. So, okay, cool. That gives a pretty big picture overview of 1031 DSTs.
Yeah. I'll just say this, Stephen, too, and for the audience and you, we didn't touch on the DSTs before, but like 95% of sophisticated real estate investors, attorneys, CPAs, realtors, brokers, you name it. I mean, they either don't know about DSTs, or if they've heard of them, they're really not fluent with them. So it makes, I mean, frankly, it's fun. It's why I love my job so much, is because I can deliver a solution to what I consider a widespread problem. That being that you have all these owners that don't want to be in management anymore. They don't know what to do.
Yeah.
But I just wanted to throw that out there because it's really a widely unknown structure.
So, because it's widely unknown, what are some of the misconceptions you think that are out there? Especially, I'm not sure. People come to you, you work with them, counsel them. Hey, man, Ben, I heard about this DST thing from whomever over there. Like, is this true? What are some of
Yeah,
those things?
yeah, no, absolutely. And before I touch on that, I just briefly tell the audience, like, I've been in this business for 20 years, as I mentioned. Before I started Perch Wealth, my company, advising clients, I spent 15 years on the syndication side, like putting these things together. So, like buying the real estate, doing the underwriting, the due diligence, and structuring all sorts of private real estate investments, whether it be DSTs or TICs or funds or REITs, you name it. So I'm intimately familiar with the space. The what you hear, and some of it is true. Higher fees, true. That's just true. There's no ifs, ands, or buts about it.
Higher fees than what?
Higher fees,
Yeah.
well, just in the deals. Like if you go out and buy your own deal, you're going to be paying less fees than what are embedded in a DST. Because
Sure.
there's a lot more parties involved,
Right.
right?
Yeah.
So you hear higher fees for sure. The I would say that the problem, and this kind of the problem with our space, and it is, or my space, is that it's highly fragmented and there's no transparency, right? It sounds scary, but it's kind of, there's not a Moody's, there's not a rating agency that says this one's good and this one's bad.
Right.
And you don't know who you're dealing with. And so there are concerns with our space, rightfully so. I mean, they are justified because people have gotten burnt, in the past, and it will always happen, but that happens with any industry.
Yeah.
So I would say the fees are that comes up a lot, and I would say just the folks, brokers, realtors that don't really understand the structure itself, they're naturally going to say, I wouldn't mess with it, right? I mean, try to get a CPA and CPA to say that they don't know what something is. They don't like to do that, right? Same with attorneys, so they kind of shy away from it. But there are risks. There are risks with who you work with and the sponsor company, and really that's what I do and my team does. Is we've been in this space for so long, and we can kind of weed out the bad apples, if you will, and keep you to the good sponsors along the way.
Yeah, I saw that you're 1031 exchange specialist for a couple of years as well. So, definitely helping to put those together and see some of the ins and outs on them. So that's kind of, making sure that you're always vetting who you're working with, especially getting to know them is like rule number one, right? uh,
And
do
there's still no guarantee, right? Like yeah, that's yeah,
yeah,
but I'm
definitely.
pretty good.
And I mean, how do you talk about the fees thing just as a question? Because, people, if there are parties involved, people do need to get paid, right? And it should be quote unquote, as much a market that makes sense, but also we want to make sure that, well, I'll pause. How do you talk about when someone says, Ben, what are these fees, man?
I hit them straight up, just like I'm talking to you guys. Fees are higher, and I give them an example, and I'll give you an example.
Yeah.
Yeah, a sponsor buys a $50 million property in Dallas, Texas. That's
Hmm.
the price they paid. They may offer it to you, Mr. Investor, my client, at 55 million. So you are buying into a deal, and you're paying a premium relative to what that sponsor paid for it. And so those are all the fees that that they pay us. They pay the marketing and syndication costs, the legal fees, so on and so forth. And I tell the client, look, the fees are there, and I spell it out for them. I tell them everything. So what I'm looking at is I want to make sure that income based on what you're buying is sustainable and realistic. I want to make sure there's a viable path over the next 5 to 7 years for us to overcome that 10% load in this example.
Hmm.
And and if there is, then I can get behind it. And of course, I'm going to substantiate, give you the good and the bad. Again, it all goes back to you and me, or to our colleagues that are in the game. They don't want to deal with that. But for a 60, 70, 80 year old, they've already, I tell my clients, I'm not trying to get you rich, I'm trying to keep you rich.
Mm.
And
Yeah.
so if I can increase your income and keep you rich, um, it's a win-win, right? So, but that's I just tell them straight up. And maybe it's not, for some it doesn't work, for some it's fantastic.
Yeah, but I mean that's the reality of it too, right? Like the the idea of, like you were saying, one of these uh companies goes out and buys one of these properties. There's so much due diligence of, ahead of time and deal sorting, and if they only, buy one property, the 1 or 2% that they get out of seeing 100 others, it's a good thing. So we have to recognize the work they went through that even offer it, right?
For sure. Thank you. I'm selling against my own deals, but yeah, we didn't even talk about it. The compliance and due diligence on these things are through the roof, far more so than what you would do on your own. I mean, of course, you have the appraisals and all the other title and reports, but you have third party due diligence reports, you have sponsor reports. I mean, because it's going through a securities industry,
Mm.
and like there's a tremendous amount of scrutiny. Not to say that there's not risks. Real estate deals go bad, investments go bad, but there's a lot of information there for you. Thank you for that.
Yeah, totally. I know I gotta let you go here soon, and there's so much more to cover. I wish we had more time. But what would you, what are some good questions for people to come to be more prepared before they come, to talk to someone like you to learn more about, these DSTs and maybe selling something they have? What questions should they answer before they should reach out?
Yeah, no, it's a great question. I mean, whether it's your listeners, you, me,
Hmm.
or their parents, even, right? You um, you have to assess the situation. Like, I'll just give you just random example. Like, let's say, Steven, you got 5 siblings, and your parents have a bunch of real estate or assets, and they're getting older, and maybe you're not even paying attention to this stuff.
Mm.
And this happens every day. I mean, this is real life. And you're like, hey, you know what, mom and dad, let me just take a look, or talk to me. Like, what are you earning on these properties, right? You've held these forever. You're not in love with them, or even if you are in love with them, maybe they're not generating a lot. So I would say assessing the situation, right?
Hmm.
Every day, I'll tell you, we talk to clients that They have no idea what they're making on the property, or maybe they think it's still the best investment, that they bought 30 years ago.
Right.
And in reality, they have no idea that they may be getting 10% 30 years ago. They don't increase the rents today because they want to keep the tenants happy, and it's worth 5 times as much. So they're making 1%, and they're fully depreciated. So they're paying 100% ordinary income tax on the little that they're earning. They just have no idea. So it's assessing what's going on. And then also, I gave the example of 5 kids. What happens when they pass, your parents pass, and you have 5 kids? Maybe you and your brother and your sister, you love the property, it's near and dear to your heart, you don't want to get rid of it. Then there's 2 siblings that are like, I need the money, sell that property. And there's so many conflicts that come into play. And I bring that up because in the DSTs, if they sold that property, not to say that it's the right decision in this case, but they sell the property, you go into a DST, and so your parents or my parents, whoever, they own this DST interest, and upon passing, those interests are immediately separated to each of the beneficiaries. So if you have 5 kids or 5 siblings, including yourself, and each of you will automatically inherit 20% interest in each one of these DSTs. Nobody can access it at that point until it's sold. You guys will each get your income stream. And when it is sold, you guys have the flexibility to go your separate ways. Long-winded answer, I can do that sometimes. My answer would be, you got to assess the situation. Look at what's happening, right? In the family or with your own portfolio.
Yeah. Yeah. So kind of take it, like you said, take inventory of what are the things, like what are your current life goals, and do some kind of life planning in there too, and kind of think about what it is that I actually want, because knowing what you want will help to figure out some of those strategic decisions later on. So that's a great kind of question, call to action, and of course applies to things more general from a financial investment too. Like, what do you want to do from your life investments that affect your financial investments? So, dude, there are a couple of things I wish we had time to talk about. Would love to have you on again.
We can do it again.
Yeah. Talk to me, Ben. Where can people find you? What are things you mentioned, not just listeners, but maybe their parents or people that have other properties, their ownership, that are looking to maybe take advantage of 1031s or DSTs. What kind of questions should they come and ask you about? Where can they find you?
Yeah. The company's Perch Wealth, www.perchwealth.com. I have a business partner. We have 10 advisors on the team throughout the country. We're in Texas, we're in Arizona, we're in Georgia, we're in Florida. We're all over the place. So we work with clients nationally, and we're big on education. So I don't care if you're thinking about selling a property in 2 years, or you're just trying, you have basic questions about 1031 exchange, the rules, the guidelines. Feel free. You can call me, you can call the team. Everybody's on the website. I give out my cell phone number, and you can call me and I will call you back. It's 818-269-4972. Again, 818-269-4972. So either our website, you can call me direct. Feel free to reach out to us.
Sweet, dude. I will make sure all that is in the show notes as well. Appreciate you, man.
Yeah, thank you very much. It was a pleasure.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.